The topic: how to build a tax-efficient taxable account as a physician. Tongue twister, right? But the taxable account is going to be a vital part of your financial plan, because eventually you max out all those qualified plans, and your next best option for most of us is going to be the taxable account. So we will walk through in this video just the basics of what a taxable account is. But we're going to go a lot deeper than the basics. The blog post that I built this off of was one of my most detailed blog posts. The actual words were around 4,700 words. So we're going to go how to actually make them tax efficient. What should we be looking for? What's asset location? How can we factor in asset protection? As a physician, one of your most at-risk accounts is likely your taxable account, depending on what state you live in. We'll also do some bonus topics. I want to walk through some taxable accounts for kids. So with that, we'll go through also the UTMA, the UGMA. Again, just kind of varies by what state you live in, but we are going to go through all of our favorite tips and tricks on how to make that taxable account as tax efficient as possible. So stay tuned. That's all coming up next. First topic: what is a taxable account and why should a physician be using it? Now, in this video, I won't reference all the charts and graphs that we'll have in the blog post. So in the notes for this video, we'll have a link to the blog post. And it might be helpful to have the blog nearby to reference, because we'll have those charts in there. Plus, over the years, while the video will still be live and active, if the tax codes change, we can get in there and update that information in the blog as well. So then it just gives you a more current reference. So first and foremost, what is a taxable account? Taxable account, for all intents and purposes, is a brokerage account. And the most common forms you see it in is an individual account or a joint account. And then with the joint account title, you usually see it one of two ways. Something called joint with rights of survivorship. Usually that is your most common form. However, we'll hit this better in the asset protection section. If you live in one of the few states that allow something called tenants by the entirety, or tenants in the entirety, call it a tie account, you have a great option there for asset protection. So one of our favorite terms for physicians, asset protection, wherever we can add it in easily without some crazy estate plan built into it, we love that. So always look for the tenants by the entirety if you live in one of those states. We will cover those states a little bit later on in this video. So with that, you're going to see my eyes bounce a little bit more than usual. I usually try to give you guys good eye contact here. But for this one, I'm going to read through some of the main benefits that we see with the taxable account. I just want to match them up to the actual blog post. So let me read them over to you. So first one we list here is no limits. That's one of the beauties of the taxable account. You're not limited to $6,000 per year or $19,500 or $58,000 per year. There's no limits. So that is the beauty of the taxable account. And honestly, this is one of the main reasons it comes into play for pretty much, I wouldn't say pretty much, it comes into play for all physicians. Just depends on where it comes into play. But eventually you max out your 401k, you max out your 403b, you max out your 457b, you're doing your Backdoor Roth IRA. You hit this point there where you say, well, what's next? And for pretty much every single physician, it's going to become your taxable account. So that's why it's such a vital topic to the physician community, because you're likely filling up all your tax qualified buckets. So then next up is going to be your taxable account. So there's flexibility in how you would save, the timing, the withdrawal. So it's an extremely flexible account. We always say it's your most accessible account by far. There's no forced withdrawals. So depending on where you are on the age spectrum, some clients have heard of something called RMDs, some have never heard about it, but an RMD just stands for Required Minimum Distribution. As we currently sit here, the age is 72, which means Uncle Sam will force you to start pulling money out of pre-tax accounts, example 401k, 403b, once you hit 72. Most of the time, it's probably already in an IRA by that point, but still RMDs are going to come into play there. RMDs are also a big factor in our tax planning. So again, the big benefit with the taxable account is you're not getting forced to take those RMDs. No penalties. So no 10% penalty when you pull the money out before 59.5. You could really argue your biggest issue with the taxable account would be if you sell less than a year and you're triggering short-term capital gains as opposed to long-term capital gains. But this is really important for any of our physicians that are looking for earlier financial independence. If you're looking to retire at 50, you need to have a good plan in place on what's the best way to get assets. Yes, there are ways to get assets from qualified plans. You can use something called a 72T. So there are workarounds there too. But this is just a very good accessible account if you're going for an earlier retirement or an earlier financial independence, because it gives us flexibility there. It's also just good on taxes. Depending on how you want to look at this, we kind of list a few ideas in here. There's passive, there's long-term capital gains, qualified dividend rates, losses can offset gains, and as a high-earning physician, if you offset more than your gains, you can actually offset $3,000 per year of income. So a little bit of tax arbitrage in there. Depending on where you're using it, you could be having tax-free income. Kind of give a shout out here to our municipal bonds. Depreciation. So in this example, this would be more or less if you're putting some real estate in there, which we will actually cover real estate in this post as well. And then no payroll taxes. There's just a lot of tax benefits to the taxable account as well, which kind of sounds funny to say because tax benefits, but the account's called a taxable account. But this is why we're going to go through the details. And one of the biggest benefits is if you pass away with this account, your heirs get a step up in basis. So you have an account that is worth $1 million. You pass away, and let's just say 500,000 of that was gained. So you put in 500, it gained 500. Your balance is $1 million. You pass away. Your heirs' new basis will start at $1 million. So essentially it becomes a tax-free asset depending on when they would sell that. So one of our favorite features of the taxable account is that step up in basis. In the actual blog post, I listed the current tax brackets. I listed the current long-term capital gains rate. So remember, if sold less than a year, you got to worry about ordinary income tax. If you sold it longer than a year, you get long-term capital gains, which for most, we say you're going to be somewhere between 15 to 20. Most physician households, especially if a dual physician household, you're probably on that side of 20. There's also something called the net investment income tax. That's likely coming into play here. So even 20 is not, you're going to get close to 24 more than likely. So I'm not going to reference those numbers in this video, but I would suggest going to the blog post only because when I'm recording this, it's towards the end of a year, so I know that I got to make updates for next year. So I'll let the updates come into play on the blog post. I'll update those tax brackets, I'll update those capital gains, and any notes or amounts we need to update in the blog post as well. So I will leave that at that. I also put a little snapshot utilizing a 2020 1040, at least in the blog post now. I might update that once we get the 2021 1040. But even showing you where these things are listed on your tax return, right? Seems like a simple thing, but most clients don't know, or most individuals don't know where these are actually listed. So you'll be able to see the actual lines and then where they are as well. Again, I won't reference those lines only because the lines often change year to year as well. So I'll make sure I put an updated note in there for you guys at all times, but just make sure you circle into the blog post to see those updated numbers, and that way we can really give you the most relevant and most recent information by the time you watch this video, but you can see it on the blog post. Next section, going to be a favorite. What strategies can I use to pay less taxes? So one of my favorite sentences is, we're happy to pay Uncle Sam. We just don't need to leave Uncle Sam a tip. That is the whole game behind taxes. You're trying to be as efficient as possible. I would say it's also very hard to beat the tax code in a given year, but with some proactive strategies, you can become very tax efficient in the long run. Now that varies from year to year, right? We get new tax code updates that could change. But tax planning for most is a very long-term game. And that's where tax strategy is vital to any good financial plan. So what I'll do, again, you'll see my eyes bounce a little bit more than usual, but I want to actually follow the blog post to keep it organized from the video to the blog post. So first up, very common buzzword, tax loss harvesting. So tax loss harvesting means that essentially at the end of the year, you take an inventory of what's in there. If something has a loss, you sell that, which would then offset gains. If you have a certain amount of losses, let's just say a large amount of losses, hopefully that's not the case, but again, we're trying to be smart here. If you have up to $3,000 of losses greater than your gains, you can actually offset that on your ordinary income tax. If you have even more than that, so let's just say losses offset your gains and you had a total of $10,000 left over for easy math. Current law says you can offset $3,000 of ordinary income, and then actually another $7,000 can roll over. It's called a carry loss forward. You can actually roll it over into the next tax year. So that is one of the benefits with tax loss harvesting. I always put a little bit of an asterisk with tax loss harvesting because at the end of the day, you're still delaying, hopefully, what is a gain. Now, there is strategy in there if capital gains rates are lower 1 year compared to the next year. We don't know what they're going to be 5 years from now. Heck, we don't technically know what they're going to be next year where we're currently recording this video. So there's a little bit of shifting in there, but just keep in mind, if you want to make a taxable account very tax efficient, look to take advantage of that tax loss harvesting. One other item in here is something called the wash sale, though. So a wash sale just says you can't go in and sell a fund, realize the loss, and then buy that same fund within 30 days. What you need to do here, and in the blog post, I actually took a screenshot of a Vanguard fund just to show you where something which is called the QSIP. The QSIP is like the address. It's the identifier for an ETF or a mutual fund. And the best way to describe it is you can't buy something with the same QSIP. So if you had the Vanguard S&P 500 and you sold that to get the loss, you likely can go over and get the iShares S&P 500. So that's why, just with a little bit of research, you should be able to avoid that wash sale. But something that's really important, we don't see it all that often because we do think there is pretty good education out there on it. But if you're just getting into taxable accounts, just always keep that in mind. You can't just sell it for a loss and then go buy it the next day. So that's one thing to keep in mind. Another thing is what we call donate or die with an appreciated stock. Probably could have used a more subtle title there, but here's what we mean. You bought a stock. Plug in, I always use WealthHeal. We were not publicly traded. Use WealthHeal stock as an example. You bought it for $10 a share. You're getting, let's just say you're getting older now. We're more in that retirement planning, decumulation phase of life. But your $10 per share WealthHeal is now worth $500 per share. You sit there and you say, well, what do I do with this stock? Well, you have two really good options. Option one would be don't do anything with it and die with it. Because remember, when you pass that on to your heirs, they get a step up in basis. Or donate it. Because when you go to donate that stock, you actually get the deduction for the full value. But the charity is not going to be paying taxes on it. So it's a really, really great opportunity to donate the stock. If you were already charitably inclined to, it's perfect, right? It gives you a chance to donate that. You're not paying taxes on it. So that's why we come down to two things that say donate it or die with it. So any highly appreciated stock, sometimes we'll call these our legacy stocks that you've just had for a long time, or maybe you got not long ago, but they've just been, on a rocket ship up. So keep that in mind. That's another good tax efficient play here on the tax efficient side of it. The other thing to always keep in mind is something called a donor advised fund. We call it a DAF, but you could donate that appreciated share to the donor advised fund. And truthfully, sometimes that's a little bit easier even for the charity. Not all charities are set up to receive stock. So if you transfer that into the donor advised fund, you get the deduction for that full amount. Let's just say you would liquidate it in there and then donate the cash to the charity. That's why sometimes a donor advised fund can make that a little bit easier. Most custodians have a really good donor advised fund set up, easy to open, I should say. So Fidelity has a good one, Vanguard has a good one. Fidelity has no limits. Vanguard's is, at least at the time of this recording, they're still at $25,000. But that's another thing to keep in mind to utilize that donor advised fund when you donate that appreciated stock. A few other benefits of the donor advised fund, because I do think this is a fantastic account that I don't want to just gloss over. You get the itemized deduction for the full value. Kind of noted that, but just wanted to go through that. There's no capital gains for you, none for the charity. A true win-win, as we call it. You can keep the cash in your pocket. So this is one of the beauties of donating that. So if you were already going to write a check for 10 grand to the Red Cross that year, you keep that in your checking account, move the appreciated stock over to the donor advised fund, then donate your 10 grand. Again, you avoided taxes, gave the 10 grand to the charity, you kept it in your checking account. Also, depending on where you're on the age spectrum, this is also another huge benefit to something called QCDs, Qualified Charitable Distributions. qualified charitable distribution. Yeah, making sure I got my letters right. QCD. So that's another thing to keep in mind. Just kind of throwing a bonus tip there for you. No wash rules. So you can donate it and then buy the same stock. So if you wanted to get rid of the highly appreciated stock, but you really believe in that company still, you can still buy that. You don't have a wash sale issue there. So kind of a hidden gem inside of there. The other thing too, you can keep it anonymous. We kind of put in one of our favorite quotes from Dr. Dolly. He calls it charity porn. A unique description of it, but I get what he's saying, because if you've ever made a donation to a charity in your name and they have your address, you sometimes wonder, are they sending you more things that actually offset your charitable contribution, because they send you all these fancy flyers and brochures and little widgets and gadgets, and you're like, I don't really need all this stuff, guys. I just really wanted to make a charitable donation, wanted to help some people out here. So by using a donor advised fund, you can keep that anonymous. So it's kind of another hidden gem in there. But I did not want to skip over those because the donor advised fund, while it's not technically part of the taxable account, it is a way to make your taxable account extremely tax efficient. So I kind of wanted to give you a little bonus section for the donor advised fund, or what we call the DAF. All right, our next section. How do you actually build a tax efficient account? So in this section, what we'll do is we'll actually walk through 3 asset classes. We're going to hit stocks, bonds, and real estate. Again, you'll see me bounce a little bit because I want to follow the actual blog post to give you good tips here. So in the actual blog post, we gave you good screenshots. This was probably one of my best give you actual live examples from screenshots and data blog posts I've ever built, because I feel like a lot of these topics we maybe heard of, but we didn't know where to find it. So the first one we're going to go through is stocks. Stocks are a pretty efficient item to hold inside of a taxable account, especially if they are more geared towards growth, not income dividends. Also, take a look at something called the turnover. So a lot of the, at least for most of our clients and most of the individuals we work with, we're utilizing a lot of ETFs and mutual funds. So inside of there, you got to look for something called turnover. So we use an example with the iShares Core S&P 500 fund. And we use the Morningstar report, and the fund has turnover of 5%. So that means that the fund will turn over in total once every 20 years, which makes sense when you think about it, because the S&P 500 doesn't have a ton of stocks coming in and out of it, and this should be mimicking the S&P 500. So one thing to keep an eye on is the turnover. The other one is distributions. Check to see what the distribution schedule is. Now, what we did we took this one, we did the Vanguard Total Stock Market, and we actually pulled a chart from BlackRock. And because we can keep this updated as the years go, I won't actually give you the exact numbers. But you can see on our list the total distribution and what was listed as income. So you're just trying to see, all right, I bought this ETF. How much turnover does it have? Because turnover can create a 1099, right? How much distribution does it have? Why? Because it can create a 1099. We're trying to make your tax efficient account. We're trying to make your taxable account tax efficient. And then with that comes in dividends. So if you're not in a more growth-based stock, whether it's an actual individual stock or an ETF or a mutual fund, you then also want to keep an eye on the dividends. So I gave you another chart. This one was actually through Y charts, and Y charts would actually show you, was it non-qualified or qualified? Because that's also important for your taxes, because you have different tax rates in there. It'll tell you what the amounts were over a given period of time. So the main goal with stocks, or however you build your tax efficient portfolio, is, especially if you're using ETFs, mutual funds, you got to keep an eye on the turnover, keep an eye on the dividends, keep an eye on, what did I say here? What was my order? I mixed them. Keep an eye on turnover, distributions, dividends. Those are the 3 things you're keeping on. Now, if you go buy an individual stock, you're not going to have turnover. You could certainly have dividends, right? So you got to keep an eye on the dividends, what they're spitting out there. So individual stocks, you get a little bit easier on this. There's not as many moving parts to it. So the next up would be bonds. So with the bonds, you're really trying to keep an eye on, for this we always say you're really trying to focus here on municipal bonds. So in a taxable account, as a high income earner, which again we'll say is going to lead to you being in a high income tax bracket, you want to be as tax efficient as possible on the bond side, because bonds will spit out the income, right? That's kind of why you hold bonds. So at least when we build our client portfolios, even in a taxable account, we won't put everything in a municipal bond. You still need to have some bond diversification in there. So usually we're looking at like a 50-50 split between taxable bonds, but looking for tax efficient taxable bonds, and then municipal bonds. There are a few states, using Vanguard as an example, there are a few states that even allow you to use municipal bond funds for the state. And if you're not familiar with municipal bonds, I should probably have led with this. The big benefit is they're exempt from federal taxes. But if you live in a high income state, you could also be exempt from state taxes. So for example, Vanguard offers Pennsylvania, California, Massachusetts, New Jersey, and New York, and Ohio. Those are all states that if you buy those municipal bonds, you could avoid federal taxes and state taxes. If you have local taxes here, you might be a little bit out of luck. But technically, if you get the whole way down to municipality, use Philadelphia as an example. If I bought a Philadelphia issued municipal bond, I could avoid federal taxes. I'm located in Philadelphia. I could avoid federal taxes, state taxes, and Philadelphia taxes. Now, I know not everyone has local taxes. That's only kind of a few of us are only so lucky to have those. But that is one thing to keep in mind. So start to look at those municipal bonds inside of there. We also put some notes on treasury bonds, some savings bonds. So I put a few other notes in there. And then one of my favorite charts that I built in just to give you something to reference is who should be using municipal bonds? Well, it's actually a pretty simple calculation. So we give you a little chart in there compared to the tax bracket and the yield to see what the actual tax-adjusted yield would be on a municipal bond versus a taxable bond. And this is also one of the reasons why we mix in taxable and municipal bonds, because as rates change, as tax rates change, you can go through kind of different phases where it might be a little bit more tax efficient than other. So head over to the actual blog post, and we have a good example in there, and we pretty much show you the math as well. So easy calculation, probably one of the more easy calculations. One other section I want to cover here is real estate. Real estate is one of our favorite other asset classes for a few reasons. Most of it comes down because you can really make these tax efficient. So one of the things we note here is if you're going to own it through like a self-directed IRA, that can get a little bit complicated. There's a lot of moving parts you got to follow. You don't ever want to essentially hurt the tax qualified status of your IRA, or it can lead to some pretty bad tax events. But we also go through just some of the benefits of rental real estate. And you have income coming in. Depreciation usually offsets most of that. There's something called a 1031 exchange. One of our favorite things that we tell our clients, in a perfect world, you will buy a property, depreciate it, 1031 exchange, somewhere in there, force appreciation as well. Depreciate it, exchange to hopefully a larger property, rinse and repeat, do that again. So 1031 into the new property, depreciate, somewhere in there you force depreciation to, exchange, keep doing that over and over and over again. And if you do that, you could pass on to your heirs a huge real estate portfolio completely tax-free because they get that step up in basis. So keep that in mind. Also take advantage of the 199A deduction up until 2025. If you have not heard of the real estate professional status, give that a look. That is one of the really, really cool benefits. Now you can't do this with one single family. There's no way. You need to be donating. I shouldn't say donating. You need to be working at least 750 hours per year. That turns out to be about 15 hours per week to real estate. So you have to have a few properties here, or one or two multi-units. But if you really want to get hyper tax efficient, check out that thing. Again, the real estate professional status. We call it the REIPs. But that is a really nice benefit on the real estate side. So main goal here is just to give you more information on how you could build a tax efficient taxable account. And some of those, like rental real estate, you wouldn't be holding those in your taxable investment account per se, but it would give you another way to continue to build a tax efficient overall financial plan. So as you can see throughout this video and throughout the blog post, we're trying to build in some other ideas too, some other ways to stay very tax efficient. All right, next section, kind of a little bit of a detour here. Taxable accounts for the kiddos, also known as UGMAs and UTMAs. UTMA stands for Uniform Transfer to Minor Act. I'm so used to calling them UTMA and UGMA, I actually have to read them off a list here. UGMA is Uniform Gift to Minor Act. They're the same thing, it just kind of depends on what state you're in. So why are these accounts in this video, in this blog post? Well, here's why. So why they're taxable accounts, they have some unique tax thresholds. I will read you the 2021 numbers, but in the blog post, if you're watching this video and it's not 2021 anymore, I'll make sure I update those. So the first $1,100, 2021, is unearned income of earned. Let me try this again. The first 1,100, again 2020, in unearned income is tax-free. That was a tongue twister. The next 1,100 in unearned income is taxed at the child's tax rate. More than likely, probably 10% or a very low rate if that changes at all compared to 2021. Anything above 2,200 is taxed at the parent's rate. So somewhat of a unique account that you can start to build in here. Now, with that, if you are watching this and you're a current client, you're probably saying, Chad, you've never been a big fan of these accounts. And here's why I'm not the biggest fan of the accounts. First is it's going to hurt you in the FAFSA. Now, as a physician, and 95% of our clients are physicians, the odds of your children getting needs-based financial aid likely pretty low. So that could be a moot point. The other item I don't love is, depending on when you're getting this set up for your kids, they get control of the asset no matter what. So if little Johnny or little Susie is a little hellion, you can't stop that from getting to them. Call it 21, but some states as low as 18. In the blog post, we actually put a link so you can click on your state. But at 21, you could sit there and say, depending on the value too, what if it could be six figures? I mean, who knows? Maybe we're really cranking away. Maybe it's a seven-figure number. They get that money no matter what. And why we'd like to always think our kids are going to be smart with it, I can tell you right now, if my parents gave me a large amount of money at 21, I'd like to sit here and tell you that I would have invested it like a smart individual, but I probably would have taken a pretty crazy trip somewhere, maybe did some things that I am not proud to tell you about, but I probably wouldn't have been the smartest with it because at 21, I'm still a baby in my brain. I'm not mature enough to think through this. So that's usually my biggest issue is no matter what, they get that asset. So that's always my little, kind of put my asterisk up here. I think I even put a note about that in the blog post as well. So this is really just a bonus account. Now I would say accounts under 100,000, you probably don't have to think too much about the taxable issues there because when you would just do the math on it, it's probably going to always be under those tax limits. Above 100,000, you probably have to get a little bit smarter here and just make sure that you're not going above these limits because as soon as it gets into your tax rate, or assuming the parent's tax rate here, you're starting to lose some of the benefits of it. But if you can keep it under that 2,200, you have some tax arbitrage working in your favor. So bonus little section here, mini detour, but keep an eye on taxable accounts for your kids. UTMA, UGMA. Next up, asset location. One of my favorite topics, and I would say a huge part of a good, thorough financial plan. Asset location can get a little bit tricky depending on where you are in your financial plan journey. Earlier on, a little bit harder, in my opinion, only because you're in such a accumulation phase with time on your side, you're probably more tilted towards stocks, right? Later on, asset location gets a little bit easier, in my opinion, and we've guided clients through this whole spectrum, so just my opinion. But with that, it's also easier to build out those buckets later on, and we actually call them buckets. It's much more easier to explain to our boomer physicians or baby boomers that are closer to retirement or getting close to it or in retirement and really walking through that. So asset location is vital. It's a huge part of the financial plan. So I put 4 lessons for asset location. So I'm going to read through these. Now the list looks a little bit weird. I essentially have 3 in there, and then I have a description of number 3, and then I have number 4. So if you're watching the video but still referencing the blog post, just understand that's how the list kind of builds in there. So first up, again, you'll see my eyes bounce a little bit. I'll even read to you here. If possible, keep everything in tax qualified accounts. For many physicians, this is likely impossible. And if it is possible, you are probably not saving enough. So that is the first thing to keep in mind for asset location. You're going to have a taxable account. As a physician, if you don't, like like I noted there, we probably have some issues. Tax qualified accounts should be your higher ratio, especially earlier on. This is good because you have less tax drag, but you also have probably your best asset protection there. 401ks, 403bs, you have ERISA on your side. ERISA is ironclad. You can't get through that. Most states and also the federal government put pretty good protections in place for IRAs, Roth IRAs. As I noted earlier on in this video, your most at-risk account is usually your taxable account. Avoid taxable income. So number 2 and 3 will always be siblings that fight, but number 2 tells us to have better growth potential in your tax-qualified accounts, aka stocks. While number 3 says to have income-producing investments in your tax-qualified account, aka bonds. I put REITs, but you can really plug in real estate in general here. Number 2 and 3 are why I think asset location is more of a moving target than exact science. All right, so that's just kind of thoughts from my brain that I put on paper, reading out loud to you. So we then list 4 different ways to think of really your ideal for a taxable account. Then we put your next group, and then last resort. So our goal here is to walk you through, if you had to have certain assets in a taxable account, here's our list that we would follow, at least based today. So first up, municipal bonds, muni money market, precious metals. On paper, you could actually add in cryptocurrencies here. But my concern is that's going to continue to get more and more regulated. So it might not be as tax efficient. But as we sit here right now, it's actually a pretty tax efficient holding. Next up, especially if we're in a low interest rate environment, which we are currently when I'm recording this video towards the end of 2021. If you're in a high interest rate environment, you're likely going to flop 2 and 3. So even a little bit of agile in here. We'll keep it agile. So next up, taxable money markets, corporate bonds, TIPS, but beware of taxable income, treasury bonds. Number 3, which would be flipped with number 2 in a high interest rate environment. But here's where we get into U.S. stocks, more passive. International stocks, again, more passive. Emerging markets, ideally more passive. Equity real estate. Last resort for taxable accounts. Essentially things you're not really trying to have inside a taxable account in any world. Actively managed funds, REITs, junk bonds, debt real estate. Just the way that they're spitting out income, you're probably going to have some issues here. Actively managed funds, higher turnover. Higher turnover means more tax events for you. Again, REITs, junk bonds, debt real estate, the way that they spit out the income, you're going to be hurting yourself. So that was essentially a better description to number 3, which again, kind of also references 1 and 2. The next one we put in here is number 4. Simply put, try to avoid placing sells in your taxable account. No selling, no capital gains. So the longer that this plays out, and we put notes here on the donor advised fund, we also put notes on if you were to pass away and then pass it on to an heir. We also put real estate in here, our 1031 exchange. If you are a real estate investor and you have not heard of 1031 exchanges, put that down on your to-do list for this video now, something to go look up after this. But ideally, the less action you have inside of your taxable account, likely the more tax efficient it's going to be. All right, so those are some good tips on making sure that you're really keeping this as tax efficient as possible, utilizing one of my favorite topics, which we call asset location. Next topic, rebalancing, but in a tax efficient manner. Another very common term in the investment world, rebalancing. One of my side notes is the word is probably a little bit overdone. Historically, if you kind of look, you probably need to rebalance most of the time, maybe once every 3 years. We usually are looking at least annually to see how much portfolio drift was in there, but for the most part, they don't drift all that often. And with that, remember, going back to rule number 4, we're trying to avoid placing sells. So giving yourself maybe a little bit further parameters for any type of portfolio drift are helpful here because then you're not placing sells. But with that, let us give you some tips and tricks on how to actually actively rebalance as you move forward. So first up, if you have losses, you can use those losses to offset the gains on those rebalances. Give yourself a clean slate. I put a little note here on rebalancing. The next one is rebalancing too frequently. Just set your drift parameter. I feel like I actually hit the second one pretty good. So again, I'm still referencing the blog post here. This was one of our favorite ones. When you put in new contributions, use that as an opportunity to rebalance. So you have this joint account, and this is the one reason why joint accounts can have the most emotion come into play. Like take, for example, your 401k, 403b. That's likely automated, right? Money comes into your paycheck. It follows your rules that you've already put in place. Even use a backdoor Roth IRA. You likely do it once per year, right? You put your $6,000, your $7,000 in, build it, and then you probably don't look at it for another year, assuming you get it all invested right away. But your taxable account, if you're into monthly savings, dollar cost averaging, quarterly, annual lump sums that come in with your bonus or the business or whatever the example would be, you're going to have more opportunities to get this money invested. And whenever you have more opportunities, you have more chances for emotion to come in. And we're trying to avoid motion. But when you're going to put new money in, it gives you a chance to always rebalance. So if you notice a little bit of drift is occurring, you can add more money or less money to a certain area to naturally rebalance it. And why is this powerful? You didn't have to press sell on anything. So you're rebalancing without ever putting a sell order in. Fantastic, right? Super, super efficient way to rebalance. If you have a very low basis stock, look to donate it to a donor advised fund. If you're using this account to fund your living expenses, so assume that we're a little bit further down the road now and you're in retirement or in a lower work phase where maybe you're using the taxable account to supplement some of your living. Every time you go to pull money out, use that as an opportunity to rebalance. So almost the exact opposite of new money coming in. When money's coming out, use that as an opportunity to rebalance and make sure that your portfolio is up to date. I personally, again, depends on where you are. I like when dividends are automatically reinvested. But if you want to be a hyper efficient rebalancer, you could technically let those build up in cash and then reinvest it. So for example, when we're managing client portfolios, we actually will end up using that route. It'll go into cash, it'll build up in cash, and then our investment team will distribute that throughout with rebalancing. However, if you're doing this on your own at like a Vanguard, you could have their dividends get reinvested. I like that from an emotional perspective, but it isn't the most tax efficient because you didn't get to control that. So I can see it both ways here. When we build client portfolios and we're actively managing money, we will have it come into cash and then we use that as a chance to rebalance. If you're doing it on your own and you're at a fund family like a Vanguard and they let you choose that, it kind of depends, right? You know yourself better than I do. But if you can let it come into cash and then rebalance it on your own, I like that. You just got to keep emotion out of it. If you're one of those people that turn on CNBC and you say, I'm not investing today. No way. I don't like that market. No way. Look at that tape. There I might start leaning towards it. Even though it's not the most tax efficient, I feel like you're probably going to save yourself in the long run because you're keeping the emotions out of it. But I can see it both ways here. Second to last. Another thing we always tell our clients is you have individual tax lots in there. So it might say you only own the S&P 500. You have this many shares. But likely you have numerous tax lots in there. So you can also go in there and click on the tax lots and then sell from a certain tax lot. Maybe one has a smaller gain, maybe one has a loss. While the total holding looks like you have a huge gain. But you should go in there and see, because I can almost promise you're going to have a lot of variability from when you bought that stock in those different phases on what your actual cost basis is. So don't forget that you can also drill down to the actual tax lots to see what is your most tax efficient way to do this. And then last but not least, don't forget to check if you had any carry forward losses. So let's just say you had a really bad year in the past. See if you still have carry forward losses. If you do, then you have some more wiggle room to get the portfolio cleaned up without triggering taxable event. So that is really our last tip here on how to rebalance with the best of them. That should allow you to avoid sales as much as possible. But hopefully that gives you some good tips and tricks for all your current and future rebalancing needs. And we have come down the home stretch, my friends. Thank you for watching this long. I have one more good section for us. I call this our planning and asset protection section. So as I noted a few times throughout this video, for most of us, the taxable account is probably our most at-risk account. And physicians love the term asset protection, even though I always say that it's not that common to get sued above your malpractice limits and lose. Sure, it happens, but it's not that common. But for whatever reason, our physicians are always, how do we do asset protection? Asset protection. I love asset protection, more asset protection. So let's do a little bit of asset protection now. So first up, the first one's technically more estate planning, but do not forget, if you can die with this account, if you can die with these assets, it is your best estate planning tip because you're going to get a step up in basis. So this is more estate planning than asset protection, but just keep that in mind. If you can push that off, that is ideal on how you would do it. The other thing is, which is a unique trick here, is don't forget that you can also push your date of death back 6 months. Now, it's not going to help if you take that note because in this example, technically you're dead. But that is a good thing for your heirs to know. But more importantly, I hope your estate attorney would know this. But that's another thing to keep in mind because if the stock continued to go up for 6 months, take that 6-month valuation. That could also help you a lot. Now we'll transition a little bit here to asset protection. First up, my favorite topic, and I noted it earlier in the video. Look for tenants by the entirety. I'm going to read the states to you right now. If you live in one of these 18 states, you go and thank your legislators. I'm in one of those states, so I'll start with Pennsylvania. The next are Alaska, Arkansas, Delaware, District of Columbia, Florida, Hawaii, Maryland, Massachusetts, Mississippi. MS is Mississippi. I think so. I'm just going to say whatever state is MS, you're in there too. I'm almost positive it's Mississippi. The next one is MO, which is Missouri. I know that one. New Jersey, Oklahoma, Pennsylvania, Rhode Island, Tennessee, Vermont, Virginia, Wyoming. Here's a little side note. There are 6 states that allow tenants by the entirety, but just not on your personal assets, like investment accounts. But you could do it for your home, your real estate. Illinois, Indiana, Kentucky, Michigan, New York, North Carolina, Oregon. I think that's 7, actually. I wrote 7 on the blog post. I think it's actually 7. So those are 7 states where you can't list your investment accounts, which is kind of a bummer. But you could have your home owned that way. So this is free asset protection. This is literally updating the title of your account or checking the proper box when you open up a new joint account. But the biggest custodians all have this. Vanguards, Fidelities, you can have this. So just if you're in one of those states and you have a joint investment account with your spouse, make sure it's tenants by the entirety. If it's not with your spouse or you're not in one of those states, it's likely going to be joint with rights of survivorship. Now, this is going to take it to a new level. And this is where an asset protection attorney is going to be vital here. Now, one thing to keep in mind, we always get a little bit nervous whenever we have an asset protection attorney say, hey, we're just going to open a trust in this state, but it's not your home state. Keep in mind that can sometimes throw up a red flag. Just, you might want to get a second opinion there. But there is something called ADAPT, a DAPT, and we call this a Domestic Asset Protection Trust. Good states for ADAPT. Got to make sure I got my letters down again. Alaska, Delaware, Hawaii, Michigan, Mississippi, Missouri, Nevada, New Hampshire, Ohio, Oklahoma, Rhode Island, South Dakota, Tennessee, Utah, Virginia, West Virginia, Wyoming. And interesting, right? That list is decently different from the tenants by the entirety. So this is a pretty complicated topic. And usually one that and I'm not going to say usually, every single time, you need to be working with an estate attorney, an asset protection attorney. And usually, at least from our side of advising, this is where we team up with a good attorney that we can walk through, explain it, and understand the pros and cons to it, and then walk through that with our clients. So keep those in mind. Now, next and final topic is what assets do we want to leave behind to our heirs? So first and foremost, the Roth IRA. The Roth IRA is just beautiful, completely tax-free to your heirs. The next one, which is equally as good, would be life insurance. Life insurance, completely tax-free. Taxable account is third on the list. So main topic du jour today, third on the list. And really, you could say those three are kind of tied because you would get a step up in basis. So those three assets you could have completely tax-free to your heirs. Middle of the pack here, tax-deferred accounts, 401ks, 403bs, IRAs. Just a few years ago, we used to be able to stretch those out. So, for example, if I passed away and my 401k went to my kids, they could stretch it out over their entire lives. We call it a stretch IRA. Well, recently, that's been reduced to 5 years, technically even less depending on how it's coming through. So these are not our most beneficial accounts to leave behind. HSAs. HSAs are not a good tool. They're a fantastic tool, but they're a very bad investment account to leave behind to your heirs. Fun trick, if you reverse the order of this list, that is actually the best way to leave it to charity. So start at HSA and work your way backwards on how you actually want to give assets to charity. So that is a few planning tips built in there with also a very, very important section on asset protection for our tax qualified accounts and just overall general thinking of, again, estate planning and how can we do this from an asset protection perspective. Whew, that was a doozy. So like I said, this video came from our longest blog post ever. It was the first time that I got very close to a 5,000 word blog post, but it was a really fun one to write. It actually took me a while to write just because I had to break it up, but I hope you got a ton of great takeaways here. We kind of mixed in some different parts, so some may actually apply to you now, they may apply to you later, but you should get a lot of good tips and tricks here. Again, the main goal here is to build the most tax-efficient taxable account as you can as a physician. As always, thank you for tuning in. If you could give us a little like here to support this video, and if you want to also subscribe, you'll then get a notification anytime we send out a new video. And with those two items, you'll just get us in front of more physicians so that hopefully we can continue to help the physician world with the fun game of financial literacy, because as we know, unfortunately, you were not taught enough of these things throughout your very long training. So we're here to help as many physicians as we can. Again, thank you for tuning in, and I will catch you on the next video.